Joining us right now to talk about the pressures on the banking sector, Jason Goldberg, Barclays Managing Director and Senior Equity Analyst. Good morning.
Good morning.
So there was a sort of a regional bank freakout, I would call it, in the aftermath of what we saw with SVB. Then we had a lot of folks come on here talk about office, how the office business was going to kill regional banks. Then we had somebody who we had on just this week who said actually it's a multifamily that's going to kill the regional banks. And now Kashkari is going to kill the regional banks. And Fitch, which is it?
We don't
or
think,
any of them.
Yeah, we don't think any more of the larger regional banks had failed this year. That's for sure. Clearly they're facing pressures amid an aggressive Fed tightening, pressuring net interest income. Loan losses are rising, but at a very moderate clip. And now more recently we're facing increased regulation and capital requirements, and this week debt requirements were the talk. So clearly there's pressures, but we think the group can manage through it.
So when you see Fitch say this, what's the takeaway? Is there a takeaway?
No, I think clearly Fitch is acknowledging it's a challenging backdrop. I think a lot of the stuff we knew to start the year, the Silicon Valley debacle kind of added some of the pressures and maybe exacerbated some of the deposit pressures these banks were facing. But I think, again, it's all manageable in the context of their current earnings and capital capacity.
You said this year there won't be any failures this year. Does that mean because you have a fear that somehow there will be failures next year?
No, my crystal ball is only so powerful. But no, I think, we focus on the banks $100 billion in assets and above. And with that lot, I think just given their earnings capacity, they can handle a lot of these pressures that are thrown at them.
Of the regional banks that you cover, which would you like, and are there banks that you would not touch in this environment?
I think if you look at current valuations, the group's trading at less than half. The S&P 500, historically is closer to 3/4. So while there are kind of a lot of headwinds we talked about, we think the market's more than discounting them. So if you think about some of the regional banks like a PNC, a U.S. Bank, a Fifth Third, we think they're well positioned to handle the current backdrop.
Is there any that you think are not worthy of your time or resources?
Yeah, if you look at some of the banks that maybe have outsized exposure to commercial real estate, like the Zions or Comerica, something maybe more cognizant of, given that's where we think we'll see the most acute loan losses in the near term.
You just mentioned real estate broadly. Do you break it down between office and multifamily? Which do you think is more dangerous?
I think at the moment, office, clearly, just given the drop in property values, the work from home secular trend that's kind of exacerbated by the pandemic, and the backup in interest rates, you're seeing a lot of pressure there.
You don't think that the multifamily, just the amount of money that went into multifamily post-pandemic at the both height in terms of prices and in terms of low in terms of where rates were?
It's certainly something to keep an eye on. I think it varies from market to market. Some markets are more older built than others. Some markets have more housing pressures than others, which play a role as well.